Welcome to Make Your Money Matter. I'm your host, Brad Barrett. Today on the show, we're going to talk about optimizing your taxes with two common strategies. I talk about these strategies a lot, so stay tuned today because you're able to take advantage of these before year end. But before we get started, make sure to smash that subscribe button, hit the notification bell so you don't miss a single episode. All right, let's get into it. So if you look at the whole of 2023 so far, after months of sluggish activity, the market recently obviously turned a tide, if you will. And whether the market is up or down, it's always a good time to keep your taxes in mind. And more specifically, how you can put yourself in what I'll call an advantageous position by keeping more of your own money in your pockets, which I think is what everyone wants, right? So when it comes to tax optimization, there are really two common strategies that I think are really important. I talk about a lot of these here as a financial advisor at One Capital, as well as on our show. And the two I'm going to bring up today are Roth Conversions and tax loss harvesting. Now, I'm going to talk about both of these today. And I know I talk a lot about Roth Conversions, but before you tune out and understand, you gotta understand there's a lot of ways to look at this, okay? There's not just one way to skin this cat. But as always, the case in financial planning, there are also no end-all, be-all strategies or things like that include everybody. So there are several things to consider, I think, when utilizing both of these options that I want to share with you. So I think it's important, okay? So let's talk about Roth Conversions first. Okay, taxes are extremely important and obviously have a huge impact on your retirement income. If you didn't know that, now you do. So one strategy that can help lessen your tax burden later in life is converting your accounts to Roth IRAs. Now, the idea behind Roth Conversions here is to take money from a tax-deferred IRA, pay taxes on that amount at your ordinary income rate, and then convert the money over into a Roth IRA. Now, by doing this, you'll be clear of future taxes on the amount you converted, and the money you put in grows tax-free for your life. That's the good stuff, okay? Now, I want to talk about this for a second because a few episodes ago, I mentioned that at the end of 2025, our current income tax brackets will likely revert to their pre-2018 rates that I think are really important for all of us to consider. So you can revert to that video and take a look. But you can also, when we look at the national debt and potential changes coming from, say, Social Security, it's likely for many out there that think of this, that taxes likely will increase in the future. Now, it's obviously important to put this into consideration if you have a pension or things like that relative to your active income versus maybe retirement income. But even if you stay in the same tax bracket for years to come, the rate that applies to that bracket may also increase down the road. So if you have a tax-deferred IRA, you'll pay more in taxes when you withdraw from the account in retirement than you would maybe if you converted it now. So it's important to look at it. So I think the next best main question here is, what are the benefits of a Roth, okay? So to understand the Roth advantages that come with this, I think it's important to think of, imagine the imagery of a big oak tree, okay? Something old and big. Let's say you own shares with a market value of $300, and those shares are like a small acorn on this tree. If you convert those shares to a Roth, while they're at the lower value of $300, you'll likely pay less in taxes. Now, as those shares start to increase in value over time, you suddenly have this little acorn that grows into a whole big tree. Now let's say those shares are now worth $3,000, hypothetically, and all of that growth is tax-free. By the same token, you can also consider converting shares that have recently depreciated in value, and then they make more bang for your buck in that regard. You can talk to your CPA about that. Now, another benefit of Roth IRAs is that they're exempt from acquired minimum distributions, RMDs, required minimum distributions, because the IRS has already received its share of taxes from the conversions you've made. Therefore, you'll be able to leave as much as you would like to in your account without being forced to take distributions. So I think it's important as you look at those kind of things to, again, talk to your tax preparer. And this is really where you want to have coordination, I think, between your financial advisor and your tax preparer. Now, I think there's some things to consider that I want to share at least on the show today before converting to an IRA. Because if you're debating whether you should convert to a Roth, I think it's important to take some stock here, I should say inventory, put a pun intended there, of where you're at with taxes. Now ask yourself this question: what tax bracket do I feel I'm going to be in 20 or 30 years from now? Now in the past, people believed it was best to pump all your contributions into IRA or traditional one, right? Because you'd likely be in a lower tax bracket in retirement, right? Active income versus retirement income. I think if you look at it now and a lot of the rhetoric that's going on, the narrative, that even if you're in a lower tax bracket, the tax rate itself might be higher. I mean, the tax rate is really what matters, right? So want to keep that in mind for each conversion. There's two things you want to consider, right? One, you have to wait 5 years before you access the converted funds in order to keep their tax-free status. And then you also need to make sure you take the distributions after the age of 59 and a half. Those are really the important ones to look at there. Now, one other note I want to mention here is if you have or if you don't have individual beneficiaries, I think converting to a Roth account, you might want to talk about this because it may not be the best fit for your situation. That's a whole different story, right? But something to consider with your advisor, assuming you plan to leave money to maybe a charity or an organization, those donations are tax-free anyway. So it may not be a good use of your money to pay the taxes right now and convert it. But again, that's a planning question you should have, again, with your advisor. Now, moving on from Roth, which is one great strategy before year end to optimize your tax strategies. The other one is tax loss harvesting. And so tax loss harvesting is when you sell securities in a non-qualified account. So we're switching here from a tax-deferred account, things like an IRA, to a non-qualified account. Okay, think of like a trust or a brokerage account or an individual account. When you sell securities, you typically either have what? You have a gain or a loss, okay? A tax loss harvesting is a strategy used when you sell a security at a loss to offset a gain. So it offsets the capital gains taxes that you owe on, again, a different investment or another profitable one in your portfolio. So let me give you an example. If you buy a share of a particular stock for $500 and sell it when it reaches $1,000, that's a $500 investment gain, okay? Since you have gains, you have to pay capital gains taxes. And capital gains rates typically start around 15%. Again, depends on your tax bracket. Now, if you had a loss in that same account outside of that one security that I mentioned, you can use that for tax planning purposes to offset your gains on another investment, with the net result being either less capital gains taxes or none at all. Now, for this to work, you have to liquidate the losing investment before you can offset any gains on the winning one, okay? So now, I think things to consider here as you talk with your advisor and your CPA about before harvesting your losses, you want to consider harvesting your losses. You want to make sure that you are comfortable, I think, first, incurring the loss, all right? Don't be flippant with this and, have and sell securities when the market is down just to harvest a loss, all right? If this is a long-term investment, one you have faith in, one you like, you probably shouldn't sell it. But something to consider now, if you think it's going to appreciate in value, again, you don't want to be too quick on this, right? So don't pull the trigger too quick in selling that investment for the only sole purpose of harvesting the loss. Now, I'm going to shift over here for people who want to ask this question when they're thinking about, who does or maybe who this doesn't benefit for tax loss harvesting. Now, look, if you're in a higher tax bracket, you have to pay capital gains taxes on your investments, and tax loss harvesting can actually afford you huge savings on that tax. So that is for you. However, it's important to note here that in order for a tax loss harvesting to work, you have to have a few things that I want to go through here, okay? So capital gains, they don't apply to accounts that aren't in a group like a 401k or an IRA. Those are qualified or tax deferred vehicles, okay? So tax loss harvesting also doesn't work for someone to whom capital gains tax doesn't apply. So if you're in an ordinary income tax bracket, federally speaking, of 12% or below, you really have no capital gains tax to pay. So there's really no need to, quote, harvest the losses. But again, all of this needs to be talked to with your advisor and your CPA. So, given the layers of nuances here that comes with each of these, best to consult with your advisor and your CPA. I hope you enjoyed that today because I think it's really important that you go through these before year end. If you did enjoy it, make sure to subscribe to the Make Your Money Matter show so you don't miss a single episode. And always remember to make your money matter.